So good evening, everyone, and thanks for attending tonight's webinar. Before we start, I'd like to draw your attention to the disclaimer on screen that I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorized to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So as I said, good evening to everyone tonight. Thanks for attending. Tonight's webinar is entitled Master the Market Turbulence. And in the last couple of days since payrolls, everything seems to have calmed down after what was a volatile end to January. We know this could change again at any time. So Maurice tonight will start the webinar with discussing factors to keep an eye on as we go forward into the month of February. After that, he's then going to discuss that's all going to lead into nicely to what's going on with the dollar, and he's going to discuss did the weak payroll number finally kill the strength of the dollar in the near term at least. He's then going to pass on to Richard Adcock, who's going to focus on that intraday trading, and he's going to look at combining price and indicators within your intraday trading to make the most of what the tools that you have available. And he's going to use some charts, but he's also going to go to the live charts as well to discuss that further. Roger Hawes is then going to take over and discuss the first of some trading strategies that we hope that you can use, and he's going to talk about the discipline of in-flight trading. So really thinking on your feet. All right. So without further ado, I'll pass over to Maurice. Maurice, over to you.
Hey Chris, thanks very much. Welcome back everybody. I hope some of you joined us Sunday for what was the start of an interesting week. Quite a lot going on. There's been some market turbulence out there. We've seen some volatility spikes. You've all read about the GameStop and other associated single stock moves. So what we know now, well, we know, and hopefully you've all learned, that market turbulence equals volatility, and volatility is something that everybody in the real markets, professional markets, takes very seriously indeed. Volatility can change everything, and quite honestly, the emergence of the retail investors and more importantly, them working as a collective has become a bit of a game changer for markets, because as a collective, they're actually quite a potent force. And I think professionals are looking far more at what impact they could have going forwards. We're seeing at the moment small cap biotechs, for instance, moving a lot. But as you can see from the chart on the GameStop, what happened to that? That's a crazy market right there. So it was a retail attack. They were overshorted stocks and they bought some semblance of a sense to that, but it created enough havoc to sort of see some big hedge funds have to deleverage, which then spilt over into bigger, broader markets. So you can see from this S&P 4-hour chart the choppy conditions that created over that period of time. And this volatility in small individual stocks was big enough to move into the broader indexes and spark a few margin calls that people then have to cover positions to pay for in profitable areas to pay for losses that they're making elsewhere. And this is how volatility can spread. And I think you need to be very aware of what happens there. We saw a bit of a push on silver as well. Although I think there are some fundamental reasons why silver is probably going up in the commodity world, but it was an attack at $30, which they did. And since the start of February, investors and traders have been wondering what could happen next to concern risk assets, and it's something I've been looking at in some depth. My clients are asking me, what's next? Is there something I should be aware of? Now, we've got this reflation, or what you may call recovery trade going on, which is where the market is looking forward and suggesting that the recovery is on its way because of vaccines and because of a strong monetary and fiscal stimulus that's on its way as well. The monetary stimulus has been in place for a long time. The fiscal stimulus, that's the stimulus that comes directly from the governments, is on its way, and people believe that is going to create quite a boom. Now, within that boom, equity prices have definitely sort of started looking forward to pricing that in, but also commodity markets. Now, commodity markets have already had quite a decent move in some cases. You know, have a look at copper charts, platinum, palladium, silver's gone up. Grains, we've got food prices at 7-year highs. Grains are very much higher. So all of this is sort of on an expectation of quite a huge growth spurt once we sort of start unlocking, which is not an event, it's a process and will take time. But what it also brings in is increased bond yields, because that's what we expect in any recovery, that growth begets a certain amount of inflation. Now, if we get a calm and steady consequence of the world getting back to normal, we should see a gradual rise in US yields. Now, on the right here, you can see the US 10-year yield as priced in a yield rather than on a price. So prices have gone down. The yield 1.14%, you can see there, has gradually been rising. And this has sort of driven the dollar slightly higher as well, because these higher yields attract in a zero yield world, when you've got negative yields in Europe and 1.14% yields in the US, money will go to the US. And also you've got a very strong stock market there. So investors seem to be keener to be in the US than they are in Europe right now, hence the weakness we've seen in the euro, strength in the dollar. That's all very well, and you know, we were seeing that go along sort of quite nicely, but at some point these yields do have an impact, because they can get to a level where bonds become almost as attractive as the yields that we see in equity markets. Now, I've done some digging into this, and I think at the moment only about sort of 30% of equities have a yield less than 10-year yields. But if we get up to sort of like 1.6, 1.7%, I mean, you could see that move to 60% that would be less valued in yield than bonds. So this bond rise at some point could be an issue to keep an eye on, because there's another issue, and this is how quickly we get there. If we suddenly saw a sudden spurt to 1.5% from here, I think the Fed would be very uneasy with that and may feel that they might have to do something. But at the moment, you know, if it's a gradual move and we stay around here for a while and growth picks up and we gradually see it move, I don't think the Fed will have too much of a problem with that. It's a normal event in a growth phase. But at the moment, there's a lot of people like myself that believe that in a slowdown, we've got some pretty good data coming out as well. If you look at the US and China, way ahead of many others. You know, on the PMI, this is forward-looking data, and I think realistically that it's the pace of these moves that is more important than the actual price we get to. So, you know, commodities are surging higher, US yields have gone up, but they've topped out at the moment. So I think what we've seen is we've seen Chinese stock markets do extremely well. That's on the back of this sort of data. We've seen US markets do very well, and that's on the back of this sort of data. Where we've seen weakness has been the EU, Japan, and the UK, and their PMI data show us that forward-looking businesses are still not confident at all that we're coming out of this crisis. So that's why we've had this sort of move into the dollar, move into US assets, move into Chinese assets, possibly money coming out of Europe and going into Asia. And there's probably something to be said for that on a longer term basis, particularly the Asia side of the equation as we go forward. But you know, what if the UK and the EU have double dip recessions and the data is bad enough to suggest they possibly will? Then you know, capital is not going to rush in here anytime soon, and you can see that in the weak performance from UK assets and even EU assets. To be honest, you know, the FTSE 100, FTSE 250 still lagging way behind and look cheap on a global basis. So I think realistically there's no early withdrawal of monetary stimulus coming. Fed's barking, was talking earlier. We saw Mester also mention it, where Kaplan the other day suggesting they expect to see inflation. It's not a problem for them, but they're not moving or reducing, let's say, their bond purchases, which would be the first move before raising rates. They're not even thinking of tapering just yet. So, you know, the central banks still have their foot flat on the floor, on the gas pedal. And with that in mind, as inflation expectations rise, real interest rates stay low or go lower, and that is supportive for commodities. Probably pushes the dollar down a bit as well, but is also supportive for equities, which is why I think we do see this massive commitment of the size of the central banks, and now with additional help from governments, is why dips in stocks are going to remain to be bid. I'm not saying they're going straight up. I do think there are enough risks out there for us to have the odd wobble, possibly a bit more than we saw today. But I do think there is a chance that we get days like this that extend a bit more. But I do think the bids will reappear on the dips because of this constant liquidity that is being pushed into the markets by central banks, even if the markets don't need them, and even if the economy doesn't need them. You know, and again, we've got the fear index. This is a 4-hour chart. Back down, got battered down after the steep falls on the stress after the GameStop issues. And you know, basically, I've got a rough table there for you to have a look at. If the VIX, which is the volatility on the S&P, is 20 or below, I think the markets are very comfortable, probably trending in one direction, usually up. Between 20 and 30, concerns are elevated, particularly the upper half of that. Once we get up to sort of 26, 27, the market gets a bit spooked. Anything at 30 and above, then the market is actually getting stressed. And there's a lot of damage being done there, particularly in a market where we've got very high margin debt. That's people borrowing to buy stocks, dangerous. And people with a lot of leverage in, you know, call options are being used to add leverage into these moves as well. So that does sort of suggest that we could see further stress, because some of the leverage in the market is still there. We didn't really get a massive clear out, and a lot of people have got back in at higher levels. So there is some danger out there. It's just that I think that with what the central banks are doing, will keep the dips in attractive. So I think, you know, the volatility obviously matters, and you know, historically, you know, dollar weakness or strength from here? You know, that's a question that I think a lot of people are asking. But historically, we do see equity markets typically perform better when the dollar is weaker. The correlation between global equities and dollar is pretty consistently inverse. And I think realistically, a lower dollar will help emerging market equities, emerging market currencies, and emerging market stocks. So, you know, it's not just the US that benefits from this, but I do think the speed of these moves is crucial. So I think the dollar at the moment is at a bit of a crossroads. We were talking on Sunday about the dollar. We had that non-farm payroll number, which was disappointing, weaker than expected, a revision lower as well. And here you can see almost at the time that the non-farm payrolls came out, the dollar index started falling. And in fact, we've continued to fall since then. And this is a 4-hour chart, remember. Some of that is, you know, heavily weighted by the euro, but considering the euro's had a decent bounce in the middle of all this, you know, it does add weight to it. But across the board, we've seen a bounce in the Aussie, we've seen a bounce in sterling, back over 138, Aussie back around 78 cents. You know, they've been good moves. So I think realistically, there's a question here now, and it was highlighted again today by the fact that we had a miss in US inflation data. Now, I'm not sure that CPI is picking everything up, because it doesn't, and it was heavily weighted down by rents in the US falling, because half the US is moving out of rented accommodation in the cities, looking for houses in the suburbs, which weighed very heavily on that. But it was enough to sort of add a bit of weakness to the dollar, which seems to be moving back into the focus of traders now. And I'm getting a feeling with what we're seeing that this dollar may be on its way down a little bit more, having had its retracement rally And I think there's enough in place to suggest that we may see this down. And this is going to be an additional boost to things like commodities. So I think we need to keep an eye on this. The dollar in general is very important right now. And I think this should be on your screen whenever you're sort of thinking about trading foreign exchange and indeed equities or commodities. So, you know, I'm not sure the dollar rally is completely over, but I think there's enough to suggest we may be rolling over and to keep an eye on it. So I do think that's really important to look forward to. And on that note, I'm going to pass over to Richard, who's going to talk to you about some of the intraday and technical indicators so we can get a better perception on that. So I'm going to pass you over to Richard now. Rich?
Great, thanks very much, Mo. Very interesting as always. Good evening, everybody. I hope you've had a great week so far. Tonight, I just wanted to take a look and build on a couple of markets that I looked at on Sunday night, and just sort of highlight how price activity developed, and from a trading perspective, how potential trading signals were generated, and how they developed and how they evolved within the actual trading conditions. So I just want to start by looking at the charts, a couple of charts that I highlighted within the Sunday night webinar, where I was sort of suggesting that the risks were still towards dollar strength. Those of you that joined us will know about my rankings. Those of you that didn't will know I basically sort of rank each individual G10 currency by using a combination of technical indicators. And at Friday's close, we still had the euro standing at 10th with declining scores, which reflects deteriorating technicals, and the US dollar standing at second within G10 with rising scores, which was highlighting an ongoing positive development. So basically, my argument was that it still looked technically as though while we could see some further upside within the likes of euro dollar, i.e. dollar weakness and corrections, the evidence technically was still skewed towards a continuation of this negative daily trend that we've had in place since January 6th highs. Now, as we know, this hasn't proved to be the case, and we've started to see the dollar beginning to deteriorate. And in fact, what we've seen now within Tuesday's activity is US dollar scores crossing lower, and within today's activity, the euro and the Aussie, for instance, have seen their scores turn higher. So we've started to see an improving backdrop in the commodity currencies and other currencies as well, while the US dollar is starting to come under more significant pressure and starting to see technical changes along the lines of what Mo has just been discussing. So I'm going to take a look at the euro dollar and how that evolved. So on the daily basis, I was sort of highlighting the fact that having seen this sharp sell-off, the retest of this retracement, but the close below it on Thursday, the payroll recovery was impressive. And I felt that that could start to continue to see the new week with further upside developing within the euro outperforming. But my resistance focus was the 120.70 midpoint of this latest downside. Now on the 4-hourly chart, another reason why I felt that we could see further upside is on the close at Friday, we started to see this first retracement of this sell-off give way on the 4-hourly basis, which suggested we could see further euro outperformance and a recovery extended back towards this midpoint at 120.70. So my view from a trading perspective was that I was still looking for upside, but the evidence technically at that point was that upside was to be used as an opportunity to establish shorts in euro dollar, looking for further downside to develop. Now that hasn't proved to be the case. But one cross that I did look at was cable. Now, sterling was ranking first against US dollar second, so there was still the strongest currencies within G10 at that particular time at Friday's close. But we were starting to see a more improving backdrop in favor of sterling, having seen Thursday reject significantly from lower levels and Friday recover and try and push back towards this previous high. Now, that was obviously a resistance point, but I like the idea of structuring trades around, well, if I'm wrong on, you know, I feel that the US dollar is still going to come under pressure, but if I'm wrong on that, where is the greatest potential for outperformance to be seen? And with sterling ranked first within G10, higher than the US dollar, that was still my favor, that sterling would perform better than other currencies if we were going to see dollar weakness coming through. So looking at the 4-hourly chart, we could see that this resistance was still intact. So my feeling was that we could see a reaction to this short-term upside move and a pullback towards the 136.74 area. So while I was looking to sell euro dollar, on the other side of that, any correction in cable would be favorable towards sterling, looking for this retracement point to be the support level, looking to buy against and actually establish longs against the risk of upside developing. So Chris, if we can just flip to the real-time chart system, please. We can have a look at actually what happened, and we'll see with the euro dollar, we actually were standing at this. Let me just get this leveled up right. We were sort of recovering back to the retracement point on the 4-hourly basis. We were just breaking above that 38% retracement point as Friday ended. And the view was that we could see further upside towards this 50% retracement point. So from a trading perspective, I was looking to view strength as an opportunity to establish short positions. We still had the MACD below zero, so it was still a downtrend. We haven't particularly got an aggressive Bollinger Band set up, and it looks as though momentum is threatening to turn lower, though we hadn't yet seen that. So my view was really, my approach was really to use strength as an opportunity back towards 120.70 as an opportunity to establish shorts and look for the sell-off to develop. Well, we started to see the pullback and we rallied back to the 120.70 retracement point. So the short position would have been activated at this level. Now, if I was looking for a longer term short position, i.e. actually giving it a little bit more space with a stop probably placed just above this high, just above the 121.50 area, then that would have been my stop level. But as the market rallied back, I then started to see the first changes developing, i.e. the MACD started to break above its zero line and momentum having turned down tried to move higher again. So this was just something I was a little bit concerned about. And so my stop was placed above this 62% retracement level, just above 121 the figure. So I would look for that area to hold if we do start to see the market rally and extend further, if the positive dollar themes were set to resume and the market was set to push to higher levels. But you can see that very quickly we saw further upside developing. The break above this retracement point activated the stop on any shorts, and that took me out very quickly, obviously at a loss on the trade, but effectively now looking at levels that have been broken, that if this was still an ongoing positive US dollar backdrop, that resistance point should hold. It should have turned the market lower. So the fact that we closed above that point on a 4-hourly basis was an indication that perhaps something more serious was beginning to happen in terms of deterioration for the dollar. We were also starting to see the mid-average of Bollinger Bands turning higher, bands themselves starting to widen, which shows increasing volatility. Within an uptrend, that's a bullish backdrop, so we look for further strength. So, you know, with the benefit of hindsight of actually what happened, and the market has attempted to sort of push to higher levels, I feel fine having been stopped out at a fairly sort of close area just above that retracement point. Now, what we have in place at the moment is that, yes, we're still trying to extend the recovery, but if I just switch this to a daily chart, we can see the importance still of higher resistance points. So these old highs are still a fairly significant resistance focus. the daily MACD is still below zero, momentum is rising and the MACD is crossed up. So this is a further consolidation signal. So having flaunted with the short position as the market rallied back to this first retracement point, would I be doing anything here? Well, to be honest, at this stage, what we have done is break the downtrend that's connected these recent highs. And that for me is an important indication of a more serious recovery trade. And if we actually take the longer term retracement points of that entire sell-off, you can see that 121.50 is the 50% retracement point of this entire sell-off from January 6th highs. Now, we do have an improving backdrop for the euro. We've seen scores turn higher within today's activity, and that's deterioration within the US dollar as scores have turned lower. So the general consensus, in my opinion now, is that having seen this rally turning the risks for the US dollar to the downside again and upside for the euro, then breaks above this 121.50 are going to get me more focused on a more sustained recovery to the upside, having broken this downtrend. So, the evidence is beginning to develop to suggest that we can see further US dollar deterioration, especially if we start to break 121.50 and just above against the euro. So that would be the focus within that perspective. Now, cable was slightly different in that we were looking at this type of activity for the 4-hourly chart on cable at Friday's close. We just made new recovery highs, and you'll notice that actually on the 4-hourly basis that we started to see the MACD breaking above its zero line, reflecting a more positive trending condition, although this 137.58 high was still a resistance focus. Now, if we broke above that point without any sort of correction, from a technical viewpoint, that would still be a more positive development and suggest we can try and extend and push to higher levels. However, from a shorter term perspective, I came into the new week thinking, well, while we're below this resistance, and you can see it's a fairly significant resistance point, that the initial trade could be towards a setback towards this 38% retracement point. So going into the week, I had a couple of trades mapped out, one with the euro dollar and one with sterling. Euro dollar was to sell strength back towards the retracement point. Cable, or sterling against the US dollar, would be to buy weakness towards that first retracement point. So effectively, I go into the week with an idea of the initial trades I would be looking to put on, and to try and execute those within market activity. And while we were below these highs, the risk, in my opinion, was that cable could see a reaction to what was a fairly strong upside move, but still within what is a developing positive trend. Now, actually, what happened was we saw cable sell off. We didn't quite test that retracement point. So I missed the bid just above this retracement level, and we failed to really sort of use that setback as an opportunity to establish longs. However, we've unwound what were overextended conditions, and as the market then started to rally back within the next 4-hourly period, we have momentum crossing higher with the MACD above zero. So again, because sterling is the top ranking currency technically within G10, I still want to be long of sterling. Now, if that deterioration within the US dollar is going to develop into something more serious, then by using cable, we can look at that as an opportunity. So the cross higher in the momentum with the MACD above zero, for me was a trigger to look for fresh retests and potential breaks of this failure high, looking for the development of upside, with my stop relatively close to protect positions just under this first retracement point. So in other words, what was my buy level just under that level has now become the stop, because I'm having to pay a higher price on the fact that we're starting to see momentum cross higher within a bullish trend. Now, subsequently, what has actually happened is that cable managed to break this 137.58 high. So we started to see a trigger of upside coming through. And then for me, the risks would be that this is a much more serious and potentially positive development, because we've started to see US dollar under pressure, and the evidence is not only there in cable now, but also within the other crosses as well, that the upside break is looking to be more significant, and that we can start to see the potential of a more prolonged upside move developing within cables. So having gone from a shorter term potential trade, with the break to new highs, the overall risk is that we can look for further development of the positive trending condition, and the risks of further developments of what is still on a daily basis a very strong bullish trending condition, and the MACD is still above zero, momentum still rising and pushing to higher levels. So we develop the trading strategy. We go into the new week with an idea of what we want to do if certain price action develops. So we're prepared for certain price action to trigger the potential for trading opportunities. I wouldn't want to chase the market, having seen the moves that we did on Friday. So I was open to a reaction to the moves that we'd seen. But because we were still more positive on sterling, I was looking to use that weakness as a buying opportunity, which has obviously now developed into something more serious from a longer term perspective. While the euro dollar, I admit I was completely wrong. The recovery failed to see any resumption of downside, and the fact that we've now started to see more positive US dollar themes, negative US dollar themes beginning to emerge as the other currencies start to improve, then this has made me change my overall strategy. So I don't have to get married to that view. But if the information starts to change, then I will shift my focus from a trading perspective to reflect that new information. So it's being adaptable, it's being able to change your view, not become married to one particular outcome. But certainly if we start to see evidence of something more significant changing, which is against our original outlook, then we need to be nimble, we need to adapt to that, and we need to obviously take trading positions to reflect that new information. So, I mean, it was an interesting start to the week. Where we stand now is, I think, with the dollar still looking to come under further pressure, the likes of the Aussie, sterling in particular, because that's still ranked first within G10, still looks set to outperform, and the risks are for these trends to continue. But we may see a reaction to this upside move that's developed, but it still looks as though downside is limited within what is still a positive trending condition. So that's the technicals for this evening. That just leaves me to hand back to Roger, who's going to look at a very important trading strategy, and actually looking at in-flight trading and being adaptable in exactly the same sorts of way. Thanks very much, Roger.
Thanks, Richard. Great stuff there. I love the commentary, particularly around the euro-dollar trade. And those are the kind of things that we hope you're picking up as we go through these webinars. The key thing for me there, that the pragmatic approach, on the sterling trade, it was having the patience to try and get in at the right level, accepting the fact that you may not always get into that trade if the market doesn't move in your way. But with that euro-dollar trade, these are the smarts that we try and teach in terms of where I want to get into a trade, but then I've done my analysis, but then as I get into that trade, I pick up on certain other indicators that are maybe lowering my levels of conviction. So what can I do? I can either reduce my size of position, or I put a much, much tighter stop on it. And that's exactly what Richard did. It was justified because the market plowed on through that and on through the other levels. And it's that discipline there of cutting those bad ones cheaply because you kind of smell a rat a bit, or maybe your level of conviction has gone down, that will keep you playing in these markets, and hopefully keep building your P&L, because you reduce your losses and then you'll ride those big moves when they go in your favor. So great stuff there. What do we want to talk about now? What actually is in-flight trading? What am I talking about? Really, it's when we look at doing medium-term trading, when portfolio managers are looking to pick up 6-7% on a move, etc., they can study the market, they get in where they want, they can put their orders where they like, they have time because this trade is going to evolve. in-flight trading really is that short-term trading. Maybe some of you will call it instinctive trading, where you open up your screen, you want to get started, and you buy or sell according to your view, but you actually don't intend being in this trade very long. So the process of getting into that trade and then putting a stop loss in, et cetera, it's not there. So what you're actually doing is holding that risk, but you don't have that stop loss or take profit level sitting in the system. You're going to manage this trade in flight. And one of the reasons I highlight this is because that is a harder discipline. Sometimes when you've got that backup of a stop loss sitting there, you can trade a little bit more comfortably because you know it's there. You've put it there for a reason. If it goes through that level, you're out, job done. You wear your loss, thank you very much. Similarly, if you get up to levels and you take profit in there, you've got that discipline of taking profit there. Of course, you can move it as it gets to that level. On your stop losses, I would advise, you're fairly rigid unless something serious changes. On your take profits, you can adjust those as you feed into the trade and you get more and more price action. But what we're talking about here is that situation where you're in flight and you actually have to press those buttons as the market moves to exit the trade, albeit to stop yourself out or to take profit on that trade. It's a harder discipline, and it's something that we want to take a look at tonight. So to do that, we need to put ourselves in a bit of a trade scenario. I'm very grateful to Mo for setting me up here, because we're actually going to look at last week's payroll data. And again, the key thing I would suggest to everybody is trade when you have a view. Trade when you think something's going to happen. I think far too often traders will come in, turn their screen on and think, right, I've got 3 hours to trade. They start making up trades. When you've got data releases, there's opportunity there because you can do some preparation for it. And you expect the market to move in certain ways because you can deduce from certain releases, etc. If you come in on a Wednesday and the market did nothing on a Tuesday and there's no data releases coming out for 2 days and the market, volatilities are low, the VIX index has collapsed, etc., it may not be a good day to even bother trading. Why even open your account? Take that time off. So, what we're looking at here is making sure you're trading when the time is right. And we've got a great situation here. We know payrolls can excite markets. The level of expectations go up. Key thing, do your homework, do your preparation. Mo, great little bit there about whether the payrolls have changed the US dollar, but I love that chart on that bottom left-hand corner, if you can remember it, which gave you the history of payroll releases. You should all know that if you're trading payroll data. You should know the history, the shape of payrolls, because it's all part and parcel of your interpretation of the next number. So we will have done our read and research. We know we're going to trade off payrolls. We want to look at the expectations. We certainly want to make sure we knew what last month's figure was so that we can look at any revisions. We make sure on our desktop we've got all those indicators, the correlated markets, the bonds showing the interest rate moves potentially, stock markets, commodities, currencies, all those things that we're interested in and we're looking at that could give us a signal of something moving that may not have moved in the product that we're in. So we've got our desktop set up, we're well planned for it. A couple of things we're going to look at here is how I assign risk to it. And the second one will be the order management side, and in particular the short-term in-flight management. So just a quick one that we're very, very key on is how we assign risk, i.e. how much risk am I going to apply to this trade? It should be your level of conviction, the level of reading you've done to it, and where you think these markets can move in your favor and how confident you are. So with that level of confidence, should be part of your planning. So in this instance, if we're looking at a payroll release expected at 50K, just this simple graphic here should show you how your, if we get a very minor adjustment to that in terms of it comes out at 60k, yeah, that market probably has discounted that number. But as we move further and further away on the upside or the downside, our levels of confidence in terms of a distinct move should grow. And with that, we should have the ability to put a bit more risk on with a bit more confidence. So as we see, if the market moves up and it comes out potentially at 200k, we should be putting a bit more confidence into our trade, expecting a bigger move and potentially a bit more profit from it. And similarly, if the move comes out worse, then there should be an expectation of a bigger move the other way. So, hopefully that little graphic shows, if we're still want to trade and the number comes out at 75k on the upside, we can still trade, but we shouldn't be expecting too much of a move. It could be harder to get some profitability out of that trade. We may not even see some move. And our conviction that it will go our way will be less because it's actually not too much of an outlier of a number. So we should tailor our risk according to the levels of expectation and our confidence in that market moving in the way that we expect it to. So then we start talking about our order management. One of the other key things there is we're dealing over a payroll number. So you would always tailor your risk in the environment you're in as well. So, you've got the risk of your outlier and how far you expect it to move, your confidence in that move. Potentially, are you tailoring that back again? Because these generally won't be normal market conditions. Certainly last March and April, when the pandemic came out, we were not in normal market conditions. Payroll generally heightens the volatility. And you may feel, that means you should be reducing your risk according to the market conditions as well. So it's another key factor when you're looking at the amount of risk. So we're moving into a payroll day. We've done all our homework. We actually know as we set this picture out, if the number's going to come out and it's plus 200 or whatever, we feel fairly committed in that trade. So we know the levels of risk we're going to apply to our trade as well. What's the other things that we need to know before this data comes out? Well, clearly we need to have looked at the price action. We're looking at short-term intraday trading, so we should only really be looking at the price action over the last 24 hours. And we start picking out, what's been the day's low. And we see down there at 75.83. Since we've come in, given our time zone, what's been the European low, 75.99? What's been the day's high? We're up there at 76.27. These are important levels that we should have in our brain already. We're going to be doing instinctive trading, and this should trigger some reaction or some piece of order management around some of these levels as well. There's certainly levels that we should be cognizant of. And then obviously, as Richard talks us through the technical analysis side, whether we focus on Bollinger Bands, the three top, middle and bottom levels of Bollinger Bands, whether we're looking at Fibonacci levels, etc., whatever is our bag and that we feel interprets the market in the clearest way for us, we should have those in our head as well. So we've done all our preparation. There's another thing as well that we should look at, and that is price action. So as we will have seen, we can interpret this that the market actually potentially was in a bit of an uptrend, and then sometime reasonably close to the release of the number, we may have seen some profit taking. Now, bearing in mind we got tight Bollinger Bands there, volatility is low. There probably wasn't much volume going through, not much traffic. But it gives us a sense that potentially people might have got themselves long, and maybe they were tailoring some of those longs a little bit before the number. In that circle was the 10 minutes before the number. And we see two spikes there, two upward moves. Please do not overanalyze that. You're in a period 10 minutes before numbers again, where pricing is maybe slightly wider. and there probably was not much volume in that 10 tick uptick over those 2 5-minute periods. These are 5-minute charts. So don't think somebody knows more than you and that's a green light that this thing's going up. That's just a little bit of market reaction, a little bit of tailoring a position in an environment where liquidity was short. So those volumes are probably quite low there. So the number comes out, and what are we doing? The immediate thing we're doing, we're analyzing that number. We've got all those numbers locked in our head. First thing is probably a little bit of despondency. Expected 50, 49K actual. Wow, nothing's going to happen. Nothing's going to move. But obviously then we're smart. We also know we need to look at those revisions. That revision comes in at minus 227 from a 140 print last month. What have we got there? We got a minus 87. So now I'm trading revisions. Is that the same as trading the headline number? Some people may think not, but it's still a weak number. It shows some underperformance of a US piece of data, which implies a potential for a US dollar sell-off. And that's my trade. That's what I want to do. I looked at my levels of risk. Where am I sitting there? Am I at a 10 on a 1 to 10 scale? Probably not. I'm probably sitting there 5, 6, maybe 7 if I've tailored it around some volatility around a payroll data release anyway. So I know as soon as I see that, I've interpreted that news quickly, and somewhere in that box on those 4 green candles is my opportunity to buy. And here I'm buying Aussie dollars, I'm selling US dollars. That's my interpretation of it, of the news. Now, whether you're buying close to the bottom of those or closer to the high is a very, very individual thing. It's down to your speed, your confidence, how quickly you interpret this. That is a relatively short range of pips anyway, but somewhere along there, we should be getting in on that trade. It's instinctive as well, and don't always wait for everything to become obvious before you press that button, because then you may be wasting pips. You want to be getting in there, obviously, as cheaply as possible. But once you're in, and all we've done here to prove that we're not the fastest out of the blocks, we put an entry in at 76.30. What's quite interesting for that is that maybe we would have waited, although I don't think we did, for that break of that day's high at 76.27. That's a nice little line for us to have said, right, we've broken through that. I like that trade even more now. The first thing we can do, if we feel we've got time, is put our stop loss logically down there at 75.95. That's below the European low. Remember, we're doing short-term trading here, so we're not going to be putting a stop loss 100 points away, because we're not looking to make 100 points out of this trade. We're looking for a bit of short-term trading. So we've got our stop loss down there. And again, as we talk about this in-flight management of orders, if we're not going to spend the time, because we want to focus on short-term price action, to put that stop loss in the system, it has to be logged in our minds. If the market all of a sudden turned south and went very rapidly down there, because we haven't got the order in the system, we're not going to automatically be taken out. What we don't want to be doing is making poor decisions down there, lack of discipline, and we move back, even further down through that line to the 75.83 days low. We've wasted another 12 pips there because we weren't disciplined. That's where your in-flight management discipline is harder, because you've got to physically press the button. And trust me, and you've probably all experienced it, when the market is dropping very, very quickly, it's hard to press that button. It's hard to take your loss. Sometimes allowing the system to do it is the best way. But again, it's an example there of why in-flight management is a bit tougher, and you've got to be sharper and harder on yourself and make sure you're disciplined. So anyway, we're going to look on the positive side, because as Mo went through the the payroll releases, and as we've seen, with the sterling going up and Euro going up as well. The Aussie clearly would have followed as well, and that's what we see here. But now we're going to start looking at that in-flight management, and this is where we can help ourselves. If we still try and think as if we've got a bit of a medium-term trade on board, we systematically, as the market moves in our favor and we see the price action, that price action is giving us information. We need to take that information on board. So although we're trading short term, we still want to have some sort of medium term structure to ourselves, but you just got to think a little bit quicker. So we move up, we come off the highs, we come back down again, and we're forming a nice little chart level. We're still in what Richard would classify as an uptrend here because it's higher lows. But naturally, we've assessed ourselves at that higher low. What's the smart thing for us to do is use those tools, and again, in-flight management, we don't physically have to move it up, but our mind now thinks I'm going to trail my stop loss back up to my entry level. Now I've got a free trade as long as my in-flight management is disciplined and I do cut myself out if we were to dip. As we get the next move up, and again, we're talking short-term numbers here, we're only moving up another 10 points, we go through that same process. The price action gives us chart lines and signals. In this instance, it looks like we're following the pullbacks. Those pullbacks are also hitting that midline of the Bollingers. So we've got a couple of reasons here why we're staying in the trades. We carry on long. Remember, we're still short-term. And what do? We can raise our stop up to the first level of assessment up there at 76.45. Now we've got guaranteed profit, but we're still trading short term. Then we do exactly the same, the assessment at those various levels. Then obviously, when our criteria for staying in the position changes, that's where we exit the trade. And again, here, you're in the money. You've had a nice run. If you're doing in-flight management, this is where you should be taking profit. Now in this one, if you didn't take your profit, you'd probably only be wearing a few moments and points of frustration before it carried on going up. But actually what I would say here is momentum is also turning here. You know, those extra couple of ticks, if you'd have carried on, are they worth it? You know, stay disciplined to where you were going to take your profit and exit that position because it's hit the criteria for you to get out of your position. Now, some of you may say, right, short-term trading should be instinctive, and I don't want to get involved in just riding this one trade. All I will say to you is when you buy, and let's say you sell 5 points higher because you're watching every single tick go on and a tick goes up 3, 4, 5 ticks in a straight line, it comes back one tick and you think momentum's finished, I'm going to sell here. You take a 4-point profit. Lovely. Everyone wants to take a 4-point profit. But on an upward trend as you've seen here, the problem is it becomes harder if your next trade is to buy at a higher level because the trend is still there. The other thing as well is, will you ever take advantage of any of those 2, 3, 4 point dips down? Probably not, because in your mind, you only ever want to buy. So it actually will become harder to try and job 3, 4, 5 tick moves out of this because number one, too many trading decisions in a short period of time. Number two, it's harder to get back in after you've taken a profit if you've got to go and rebuy at a harder level. All these things psychologically are just making life harder for you when you actually could have made probably more money by just trying to ride that little trend, that intraday trend, the way we've shown you there. So I think I've got a little bit of a wrap-up sheet here, just some of those psychological things. You know, fast-moving markets and volatility provide opportunity, but they do bring dangers. We've put a little, a few things in there to help you. The amount of risk you put in the market is one of the key things. People underperform when they've got too much risk and it goes wrong. that's a lesson for us to walk through on another day. Keep that rigid discipline, especially when you're doing your in-flight trading. Yes, there can be times where you can change those levels, but you should only do it when you really think something is wrong. Don't get married to positions. That is very key when things have got wrong. Don't just say, no, I'm right, I'm not going to cut out, I'm going to get lazy on my stop loss. Invariably, that leads to a bit more pain. The over trading piece simply ends up being the simple fact that you can't see the wood from the trees in the end. You're too deeply involved in 3-4 tick profits that it ends up being a zero-sum game. And professional traders don't deal in the toss of a coin, and that's what ends up happening when you have such a huge batch of trades. One thing we're very keen on, and it's part of that process, Will, that we talk about, is evaluation. Now, you cannot evaluate your trading session or individual trading session trades when you're doing short-term trading and momentum trading until you are actually square. Yeah. So if things start feeling like they're going wrong, if you feel like you're chasing your own tail, walk away. Learn to walk away quickly, and then do your evaluation. Because if you don't, things get out of hand, and then it becomes very difficult to evaluate such a situation. My final point here, smash and grab trades are pretty binary in the end. One key reason why people get pushed out of trades when maybe they should be sticking in there is because they have too much risk on. Now, risk appetite is a very personal thing. So one thing I feel everybody should do is trade in the market and understand at what level you're not comfortable with loss numbers or position size in the marketplace. It's crucial as an individual. This is not a game. It's not a competition against someone else who can lose the most and still say I'm sane. This is all about you coping. What are your coping mechanisms? And sometimes those coping mechanisms are the levels of risk, because they can help you stay a little bit saner and help you control your emotions. So, don't overstretch yourself until you feel you've got the confidence and the experience to trade a bit bigger size in the marketplace. Okay, so that's some short-term trading stuff. I'll hand you back to Chris for some questions.
Thank you, Roger. Thank you, Richard, and thank you, Maurice, as well. That was some great stuff there tonight. I know, I think Richard and Maurice talked about the Sunday night. The invites go out every Thursday. If you would like to join us this week, it's 7 p.m. on Sunday, the 14th. We'd love to have you there then, and obviously you can ask questions about your week ahead. Maurice, just about tonight, a real-time update. Obviously, Fed Chairman Powell is speaking right now. Is there anything that he said that is, we talked a lot about the dollar. Has he said anything that is going to change the recent trend?
Hi, Chris. Yeah, basically he was talking mainly on his views on the labour market after the data out last week. He didn't really say anything new, and we've seen no movement in the markets at all after he's finished. One thing that I did highlight him saying was that the Fed will not tighten monetary policy solely in response to a strong labour market. So, this is, if we start seeing the unemployment rate back to sort of 4%, it doesn't guarantee that he's going to hike or move rates. He wants to see it lower than that. Even when Yellen had unemployment at 3.2%, they didn't feel that was full employment for some reason. But yeah, so he's just reiterating that it's going to take quite a sizable recovery with a lot of data supporting that before they're going to do anything. So I'm a little surprised stocks aren't a bit higher on that, but I think today is a bit of a profit-taking day in equities. But certainly there's been no move in bond markets and very little move in FX markets after his comments earlier.
All right, brilliant. So you said earlier about, you're talking about the PMI data, and we talked about double-dip recessions. Is there any evidence that would suggest a double-dip recession is more likely to occur in the EU or the UK, in your opinion, compared to the US or China?
Yeah, I mean, definitely. I think that PMI data suggests it as well. That is businesses on the ground suggesting what they're thinking about for hiring, what their new order books look like, what the outlook for their business looks like. It looks pretty bleak in the EU and the US and the UK. I think industrial production is very weak across Europe. I think it's pretty, the manufacturing base is not too bad in the UK, but service is very weak still. These continued lockdowns are really weighing hard on the UK and EU. So I think, the data supports it, to be honest. I think we could have some doggedly high unemployment in both areas as well. I do think that there's, it's going to take quite a bit for a less dynamic economy like the EU and the UK to sort of come out of this than the US. I think the technical innovation and the companies, the structures of the way business is done in the US is probably far more, and with such a huge stimulus coming as well. Having said that, I do think both will come through this, but it's just a matter of when, and investors at the moment are focusing on who's coming out of this first.
All right, brilliant. So I'll ask this one to Richard first, but maybe you might have something to say about this, Maurice, or even Roger as well. I know you all traded Swissy in your time. So the Swissy was the strongest percentage gainer versus the dollar today and yesterday. As a safe haven, that usually moves less than most, and a gold currency as well. Is there any significance in your eyes about this?
From my perspective, not. It's interesting, but I mean, obviously, I'm more interested in terms of whether that price action has sort of broken any significant levels. We took out an uptrend that's in place since January lows with yesterday's sell-off, and we're starting to see the risk of sort of more Swissy strength coming in on the back of that. But that in my opinion at the moment tends to be structured around sort of dollar weakness as well. So it doesn't really sort of reflect anything on my particular analysis. I'm sure it probably does more on Mo's.
To be honest, I think it was a position square up. I think there was quite a lot of hedge funds and high quality speculators tried to push the position the other way, and as the dollar started to rally, I think we saw quite a few people try and look for the reversal and for that to extend. And I think what we've seen now is the dollar starting to turn back down again. And I think those traders in that sort of shorter term environment have moved back out. So I think some of it's positioning, and I think realistically we are now looking at a further Swiss strength, but I think that's more against a weak dollar than it is against, say, a great deal of sterling, because we've seen sterling Swiss doing very well on the upside, and I think the Swiss franc's a difficult one because we do have the SNB who are prepared to intervene in the Swiss franc quite a lot, and they can keep that quite quiet. So it's not an easy currency to trade because of that. Certainly if you're buying it, because they don't like Swiss franc strength. So I think there's maybe even the SNB has been in there doing something with the Swiss as well.
Okay, thanks. As euro dollar is such a big part of the dollar index, if euro is slow to go up, does that potentially stall dollar selling against other currencies?
Not necessarily. I think it depends if it's inherently euro weakness or euro strength against anything else. I think if we see a broad dollar move, which we often do, then the euro sometimes can be a bit slow to move, where sterling can be a bit more agile, a bit more of a thoroughbred, if you like, can move quicker. The euro is a very big currency, don't forget, and it also has a natural current account surplus as well, which sort of attracts funds into it. But it doesn't necessarily take the big moves that some of the others get. I think generally I would say it's more or less in line, but that's the problem with the DXY. The dollar index is heavily weighted to the euro. There is a better one out there, which is one Bloomberg do, which is a broader basket of currencies. But a lot of people do watch the DXY very closely, but it is a bit distorted due to euro weightings, to be honest. Yes.
All right, brilliant. We saw, just one last question, unless anybody's got any other questions. We saw Trump, obviously his impeachment's gone ahead yesterday. They're going for it further today. Do you think this has any significance to markets? Is it a distraction?
It's not even a distraction. You know, they won't impeach him as far as I'm concerned. I would think it's probably a 30% chance of him getting impeached. But also, even if he does, he's gone anyway. The markets won't care about that. I mean, every single bit of news has just gone by, and there's just been a huge yawn from the markets on that. They really don't care.
All right, great. Thank you very much. We will leave it there. We're back on a Wednesday in 2 weeks' time, but we hope to see you on on Sunday at 7 p.m. All the best. Have a great trading week ahead. Thanks very much.